The US Fed and the central banks around the world use interest rate to change the direction of the economy. By reducing the interest rate, the Fed reduces the cost of borrowing money to businesses and people. This fuels the growth that boosts the economy during financially challenging times. Having low interest rate in the economy has its drawbacks too. Hi, my name is Sunny and welcome to my channel SunnySnippets. Here, I try to declutter some of the latest news, make it simple to understand so that my audience is well informed. It is one of the most important interest rates in the world. This is what banks charge each other to lend Federal Reserve funds overnight. The Fed requires the banks to keep certain money on hand at the end of the working day. This is to prevent the banks to lend out all they have. It also is to make sure they have enough cash on hand to start the next business day. Banks keep these reserves with the local Fed, and any bank can borrow this extra money floating around. The interest rate charged on these overnight loans is called federal funds rate. This rate acts as a benchmark for other interest rates that affects us all, like interest on credit cards, bank loans, mortgages, car loans, student loans, etc. These are important tools available to the Fed and the other central banks around the world. The Fed changes the interest rate to stimulate or slow down the economy. It reduces the interest rate if it finds the economy is slowing down or about to slow down, like what is happening during COVID-19 shutdowns. This acts as an incentive in the economy in many different ways. Number one, puts more money in the pocket of the consumers where they can go out and spend. Number two, incentivizes the businesses to invest and hire more, thus increasing the economic activity. On the other hand, during good times, the Fed usually increases the interest rate in a way to slow down the overspending and possible inflation. This also stops the creation of asset bubbles in the economy. This chart shows the historic interest rates in the US from 1954 to 2020. As you can see, the interest rates peaked in 1980s at about 20%. And further, they have gone down to almost 0% during the recession years. This up and down of interest rates is affected by the state of the economy, inflation, and many other internal and external factors. Since US is a dominant financial power in the world, so its interest rates affects the rates all over the world. The basic logic behind this is that money flows where it gets more return. When the US economy is not doing so good, the Fed lowers the interest rates to prime up the economy. To get a better return on the money, big businesses and money managers move the money outside of the US. This directly affects the exchange rate of other countries as compared to the US dollar. It is safe to assume that interest rate cut means cheaper loans for everybody. Few of them are, Number 1. Credit card rates. Since most of the credit cards are on the variable interest rates, so any change in the interest rate affects your credit card loan and their payments. Number 2. Savings and bank CD rates. A low interest rate is not a very good news for people who save their money in bank CDs. Thus, it's not a very good news for the savers. To get a better rate of return on the money, they go into other asset classes like stocks and housing. Number 3. Mortgage rates. Like other interest rates, mortgage rates are not tied to the federal interest rate. It is more complicated than that. It is more closely linked to a 10-year treasury yield. Normally, when the Fed adjusts the rate, the mortgage rates haven't always responded in the parallel. As an example, when the Fed increased the rates in 2018 4 times, the mortgage rates continued to go down. Number 4. HELOCs. These are home equity lines of credit, also called as a HELOC. These are mortgages with variable interest rates linked to the prime rate. When the Fed changes the interest rate, it directly affects interest rates on HELOCs. Number 5. Auto loans. The interest on auto loans, which are a form of short duration loan, is often tied to the prime rate. When the interest rates are low, these loans are cheaper too. This increases the ability of the consumers to go out and spend, helping to kickstart the economy after COVID-19 shutdowns. Low interest rates can be a damper on the economy and your business. Let me show you a few cases. Number 1. When you have a low CDs in the bank, it affects people with interest incomes. It forces people to look for a higher return in other asset classes like housing, stocks, etc. And this can create an asset bubble in some sectors of the economy, like we saw housing bubble in 2008. Number 2. When people start investing in other asset classes like stocks, which do not produce employment, leading to overall reduction in employment and lower wages. This can lead to deflation in some extreme cases too. In simple terms, buying power is what you can buy with a unit of money in your pocket. When we have low interest rates, the money supply in the economy is more, which eventually can create inflation and asset bubbles. This excessive money supply, along with creeping inflation, reduces the buying power over time. When the economy is good or bad, there is one single reason that affects people's financial decisions, that is the bank's interest rate. Let's take an example of buying a house. Nothing affects the affordability of a house more than an interest rate. As seen from the chart, for a $400,000 mortgage on a 30-year-old house loan, just 1% increase in interest rate can have a drastic effect on the monthly payments for the house. If the interest rate jumps from 3 to 4%, the mortgage payment increases from $1,686 to $1,909 per month. As a comparison, if the interest rate increases from 3% to say 6%, the mortgage jumps to as high as $2,398 per month. This is a very simple example where you can see an increase in interest rate affects our purchasing power. This is my take where I have tried to declutter the effects of lower interest rates on savers, people with fixed incomes, homeowners, and economy in a journal. If you have found value in the content that I make, please help me and my channel by subscribing, liking, and sharing it. Press the notification button to get notified about the latest videos that I make. Thanks for watching. See you next time on your channel, Sunny Snippets.